Hi, I'm Joe Gailey, and I want to welcome you to this educational webcast that we're doing called What Every Person Needs to Know About Income Taxation of Estates. And the key to it is that every person, this is not designed as a scholarly presentation for tax professionals. It's designed for things that the everyday person needs to know about an estate. Maybe you were just appointed an executive of an estate. Maybe you're a beneficiary of an estate. This is information you would like to know. It's also excellent for accounting students and law students, and even for newly admitted lawyers who may not have a lot of training in the things in which we're discussing. And CPAs who are out of school but are waiting to pass a CPA exam or waiting to finish that internship. This is an excellent vehicle for them to watch. With that, I welcome you. This is going to be a multiple series. There's several things that we need to tell you, and we're going to break them up into smaller parts. Today's portion is going to be on stepped up basis. And this is perhaps the most important tax benefit that any taxpayer receives when a loved one dies or when they become part of an estate as a beneficiary. Step-up basis is this. When you inherit property, you didn't pay anything for it, so you have no cost in it. Later on, if you go to sell it, you have to determine your gain or loss, but you have no cost. As a result, the tax law allows you to use what's known as a stepped-up basis. That is, you're allowed to use the fair market value of the asset at the time of the person's death as your cost for purposes of computing gain or loss. For instance, let's say that maybe your grandfather had bought farmland back in the 1930s and paid $20 an acre for the farmland, and just recently died and left it to you or to members of your family. And now that same farmland is worth thousands of dollars an acre. Your basis in that farmland is the fair market value at the time the person died. And no one will pay any income tax on the difference in what the deceased paid for that asset and what you eventually sell it for, so long as you sell it for the fair market value. Now, this is available to everybody. It's not qualifying. You don't have to have a certain amount of money to qualify for it. It's a very important part of overall tax planning. And because it's so important, you have to take steps at the time of administration of the estate to preserve it. Now, what do I mean by that? The burden is on you to prove what is the fair market value of the property. Now, for most property, like stocks and bonds, if they're publicly traded, it's just a matter of looking in the newspaper or going online and finding the closing price for the stock on the day the person died. On the other hand, if it's real estate, it's more complicated. You've got to have an appraisal done. Or, in some cases, you can use the county appraisal as your starting point for determining fair market value. Either way, you've got to put some forethought into getting these numbers relatively soon during the period of administration. You don't want to wait 20 years and then come and try to reconstruct the numbers. Now, how much money do you need to spend to do this? Appraisals are not cheap, although most residential appraisals are also not very expensive. A few $100s could save you thousands of dollars in the future. So it depends on what your plans are. If you're going to sell the property, it's definitely that you need it, a really good appraisal. If you're going to keep the property long term, maybe you don't need as good of appraisal. Maybe the county appraisal will suffice, which costs you nothing. But in either one, you've got to get that starting point, that step up in basis. This is an amazing tax benefit to everyone. However, unfortunately, it doesn't apply to all assets. So let's talk about some of the assets that it does not apply to. It does not apply to IRAs. When you inherit an IRA, that's deemed what the tax law calls income in respect of decedent. And your basis is not the fair market value of that IRA at the time of death. Your basis is whatever the decedent's basis is, which in most cases is zero because they've deducted the money that went into that IRA. So when you pull the money out, you will have income taxes to pay. Whether that money is pulled out to an individual who is named as beneficiary of the IRA, or whether it goes to the estate that was named as beneficiary of the IRA. Somebody has to pay tax on it. Now, the other common situation we see where past step-up basis may not apply is where the person who died owned a corporation or a partnership, and that corporation or partnership had assets, primarily real estate assets. The step-up basis does apply in this sense. The stock of the corporation, the basis in the stock is stepped up to its fair market value, but the cost or basis of the underlying asset, let's just assume we're talking about land that's held inside the corporation, is not stepped up. And when the corporation sells that land, it will generate taxable income to whoever inherits the stock. Now, if you have a partnership, this can be corrected very easily by making certain elections that allow you to increase the value or the basis of the asset inside the partnership to its fair market value. But this election isn't available in corporations. That's one reason why most tax professionals do not recommend that one put real estate into a corporation. They would prefer that it go into a vehicle like an LLC that's generally taxed as a partnership, because it causes a great deal of tax trauma to get these highly appreciated assets out of the corporation. And sometimes it's virtually impossible to do without generating some tax to somebody. So hopefully this will be a good overview on stepped up basis. As always, these things are complicated, and we would recommend that you use this as general information and don't rely upon it on your own circumstances, because your circumstances could be the exception to these general rules. And you'll need a competent attorney or a competent CPA, or in some cases both, to guide you through this maze. Thank you for tuning in.